Democrats abroad cannot provide individual tax advice. Advice requires consideration of your individual circumstances and needs, none of which can be done at this event. We are not tax lawyers, accountants, or advisors. Please consult a professional tax advisor, accountant, return preparer when addressing your personal tax matters. Democrats abroad does not endorse or recommend companies or individuals attending or hosting this event. The views expressed at the event are those of the respective individuals and companies, not Democrats abroad. No liability is accepted by Democrats abroad for the opinions expressed or for any errors or omissions expressed about the matters of tax in any country, your financial planning, or your legal obligations. If you need tax advice, you can consult the IRS Tax Return Preparer Directory to find an advisor or tax return preparer near you, or providing online services to meet your needs and budget. The buyers always need beware, and we have provided a link, and then of course you'll get the presentation so you can have that link directly. Good. So with that, I will hand it over to the stars of our event, Emily and Arielle, and thank you again.
So I'm Arielle Tucker. I run Connected Financial Planning. I focus on working with US citizens and their families in Germany and Switzerland primarily. Like many of you, I'm having to navigate these cross-border tax and financial issues, and that's really what started my passion into this field.
Yeah, I'm Emily Haines. My company is Expat Tax Solutions. We do US tax preparation for Americans living primarily in Germany. Started my firm in 2017 when I was living in Berlin, and now I'm kind of split between the US and Berlin. And I'm excited that you're here in person and also online, so we can answer some tax questions and provide some light into the darkness of this opaque and messy topic.
Yeah, there was a lot of questions that were submitted before the event, so thank you so much for submitting those. We'll be going through that. And then also, do you want to talk about how Minty works and how to upvote and continue to submit questions during the event?
Yeah, so for everyone here, there's a QR code on your table. So you can submit questions there and see what other people have asked and upvote them. And I believe this is also in the chat for everyone online, so you can get to the link and ask more questions. And we'll get the one with the most upvotes in that order. So we'll go through a bit of a presentation, and then when we get to questions,
Yeah, so if you attended this event in March, we did a much longer presentation as we kind of prepared for the upcoming tax season. So we've really condensed that down so we can spend most of our time today just really focusing on what your questions are. I just realized I'm like, I can't control it. Okay, so we'll just run quickly through these topics and then get right to the Q&A. So you can go to the next slide. Yeah, so just really quickly, who needs to file a US federal tax return? So really we're focusing on US citizens, US green card holders, accidental Americans. So you might have been born in the US and then left very shortly as a child and now find yourself with dual citizenship. And then those who are US residents and anyone who might have US sourced income. So that's just a very quick high-level overview of that. Again, if you look at the recording in March, we talk a lot more about some of the specifics there.
Yeah, so the filing thresholds depend on your filing status. So whether you're single, married filing separately, and these vary. So if you have a small amount of income, it's possible you don't have a filing requirement, even if you are a US citizen. I think the most notable thing on here is there's two kind of tricky ones. If you're married filing separately, so that is most people who are married to a non-US person would be filing separately, and the threshold is $5, which is incredibly low. So a small amount of interest income would really push you over that threshold. And then the second one is if you have self-employment income, the threshold is $400. So that's also quite low. So even if you have a tiny bit of earned income, if you have some sort of side hustle that is more than $400, you still have a filing requirement in the US.
The other thing we just want to kind of breeze through today is thinking about important dates. So most people are aware of the April 15th deadline that obviously has passed. That's when interest starts accruing. So if you haven't filed your US tax return, there may be interest due if you have a balance due to the IRS. So it's important to just be aware of that. This interest right now is 8%. And then the other thing to note is June 17th is the next tax filing deadline. And so if you are a US citizen abroad, you have an automatic extension. Like you don't have to file anything. You just have an automatic extension until June 17th. If you're panicking because it's June 6th, you still have time. You can put an extension in and you can file an extension until October 15th, or even potentially like December 15th. Those dates may vary slightly depending on holidays and weekends, but those are the dates to generally be aware of. Just really quickly want to run through some changes now that we are in 2024. Emily does tax. I live in tax world as well. And so we're always thinking about we're still thinking about all the tax returns from 2023 and looking at those. So sometimes I forget we're in 2024, but it is 2024 and there are some changes. So just kind of high level, a lot of people take advantage of the foreign earned income exclusion. That's very popular. You can exclude up to $126,500 for 2024. So that's increased slightly since 2023. Foreign earned housing exclusion, because it's tied to the foreign earned income exclusion, also has increased. Again, IRS interest rates are 8%. Income tax brackets are adjusted to reflect inflation. Standard deduction has increased as well. And then US gift tax limits. This is the amount that you can gift other people. So each person, you can give them $18,000 without having to file a tax return. So you might be thinking you should talk to your parents about getting that $18,000 for the year. Some other changes for 2024. We talked about this briefly before the meeting. 2024 is the final year to collect any COVID relief, but you have to file that return by June 7th.
For 2020. So if you never got your COVID relief,
you're very close to
2020.
Leave right now and go file your tax return.
Yeah, you can still get that if you get the filing in by June 17th, and then those will expire, and you can still get your 2021 COVID relief money if you haven't gotten that yet until next year, June 15th. So get on top of it.
Yep. Another thing to know is the child tax credit has increased to $1,700 per qualifying child. That's something to consider. We might touch on that a little bit later because with the additional credit, you do need to claim the foreign tax credit, not the foreign earned income exclusion. So if you're here or you're listening to this and you have small children and you are taking the foreign earned income exclusion and you never owe tax, it might be worth having a conversation with your accountant about switching and going to the foreign tax credit to be able to get that $1,700 per child. A portion of that is refundable. So that could actually be
up to $1,700 is refundable. It depends a little bit on your situation. We find a lot of these, if we take on a new client, we look at their prior year return, we're often saying like, hey, would you like us to amend this so you can get $1,700? And the answer is usually yes.
Yeah. That pays for your tax bill, right? Or your filing fee.
Yep.
Okay. And we are kind of going pretty fast, and that's really intentional. But if anyone wants us to slow down or go over anything, don't hesitate to stop us. We just want to make sure we have lots of time to get into your questions. So kind of some considerations for building wealth as an American in Germany. These are like my most common questions and considerations. And it is really difficult as an American abroad because you're basically just wearing handcuffs and you're really limited in what you can do. And if you're having water cooler talk with your colleagues about what they're doing, it might not make sense because they're not all American and you are. And so you kind of have to take everything with a grain of salt and really do your own homework. Make sure you have professionals because this stuff gets really, really complicated really fast, even if we're not talking about a lot of money. There may be additional filing requirements that you're not even aware of, even if you didn't make any money. So it's just important to be aware. So always, you always want to weigh both the US considerations and also the German implications. And again, you're really walking a tightrope here about what you can do, and you're kind of left with not very many options. Another thing that's really big in Germany that we talk about a lot is the German private pension plans. Those are really common. There is oftentimes a tax deduction. And so this comes down to, I know you've read a lot of pension plan documents, really coming down to actually reading the pension plan documents and analyzing this. Is this actually a US qualified plan? Yes or no? And so it's really hard to just take a brush and be like, these are all okay, or these are all not okay. You really have to look at the details.
And they can have quite a few different filing requirements on the FBAR, on Form 8938, and then some of them also are being treated as passive foreign investment companies, and this can lead to pretty substantial filing requirements. Yeah.
So this is just what we're trying to say is this is a red flag to just take a pause before you sign a contract. That's all I'm trying to say. Then we have German real estate investments. That's such a popular topic. especially in Berlin. I feel like everyone I know wants to buy property and, oh, I wish I bought that property 15 years ago. So it's really, again, important to understand what are the German tax incentives there versus what are the US tax incentives. I know you see this all the time.
Yes. So in Germany, you can own a property for 10 years, and after 10 years, there's no gain, there's no tax on the gain. And US people are often quite surprised to learn that as a US person, you are taxed on the gain, because as a US person, you're taxed on your worldwide income, and that gain goes into it. Usually you don't pay those taxes because you have foreign tax credits that offset it. But if you do something very tax efficient in Germany, like have zero gain on sale of a property, there is no foreign tax credit to offset that gain in the US. And so you have to pay the difference. And there's not a lot of planning that can be done around this, but there are some things that you can do, such as not selling 2 properties in 1 year. I've seen where you end up just having an enormous tax rate, and there's some foreign tax credit kind of not shuffling. There's some things that can be looked at in advance, and at a minimum, you can know how much that's going to hurt and do the calculations in advance, because I see this often after the fact. Shortly before a deadline, we're rushing, and surprise, you owe $70,000. And this is not a nice conversation to have. And it's quite common. And that's not a nice surprise, especially when it's due 6 months ago.
And one of the main problems around this is currency risk. So because you're living in Germany and you're living and working in euros, buying property in euros, that's all great. The euro and the dollar are going like this against each other constantly. And so that means you may have these, what we call like phantom gains. Like in Germany, you didn't really have a gain or a loss. But on the US side, we have to look at, okay, what was the currency exchange rate when you bought that property? What was the currency exchange rate when you did improvements of that property? And then what was that when you sold the property? And so we have all these different dates, and you can't really time, I mean, you can't time that.
It's a bit of a roll of the dice. Sometimes you win and sometimes you lose.
So I say if you make money, I mean, on the German side, then, as long as you can manage the tax bill, then you still come out ahead.
Yeah.
Okay, the other thing, so German life insurance products, again, I'm not saying don't do it. I'm just saying, like, be aware of what you're signing. Term life is generally always okay, not an issue, but other kind of, when insurance becomes a financial product, your insurance broker is saying this is a great investment. That's when, again, we just want to put the little orange flag up, take a pause, make sure you understand what you're signing. Okay, so additional issues and questions that I hear all the time. Why am I so limited as an American in Europe? And it comes down to, can you change the slide? Thank you. It really comes down to, we have the US system and the German system and the EU system. And so most US ETFs do not provide something that's called the Key Information Document, or KID, as regulated by MiFID. And so MiFID is all regulated by the EU, and that's what you as a German resident fall under. And so because as an American, we generally want to buy US ETFs because they're low cost, they're tax efficient, and they have the US tax reporting, which quite honestly is a lot more difficult than the German tax reporting most of the time. There's this catch-22 of you as a American living in Germany wanting to buy and access this and not being able to do that without going through basically a third party, unless you can prove to a financial institution that you have the net worth and the experience to be able to buy those on your own. And then also we have the additional complication of FATCA. And so with FATCA compliance, that's really requiring German and just foreign institutions in general to report accounts that are held by US taxpayers back to the IRS. And so when you walk into a German bank and you say, I'm a US citizen, do you want to serve me? They may just give you like a basic bank account, or you may have some issues getting an additional account because they don't want to have to deal with like FATCA for, every Tom and Dick and Harry that comes off the street. And then of course, I've talked about this before, but PFIC, so passive foreign investment companies, all those rules really essentially say US citizens are, really subject to punitive taxation for any type of foreign mutual fund. And so that's why it's not generally a good idea to be investing through like a local entity, or because you're gonna kind of have the ease of maybe working with a German financial institution where you live, but then the tax headaches on the US side. So again, we're back on that tightrope. We can go to the next slide. And then I included some information in the slides. So the people in this room, sorry, you aren't seeing the slide, but it will be in the recording for you if you want to go back and look at that. Just about the kind of a very high level overview of the German tax system. It is actually very similar to the US system in the fact that it is a progressive tax system. The more you earn, the more you pay, but the tax rates are just higher, as we all know from living in Germany. Let's see. Another thing I wanted to just kind of high level talk about, and we can dig a little bit deeper. We can go to the next slide. I'll skip the German surcharge. Is German inheritance tax versus estate tax. Just want to highlight this because I've been getting questions on a weekly basis about this topic. And so in the US, we have estate tax. So the estate is liable for the tax, and the current exemption is over $13 million per person. So most families are really not having to deal with federal US estate tax considerations or really advanced planning, especially because any unused exemption actually can roll over to the surviving spouse. So it's a lot of money to be able to pass tax-free. That's at the federal level. Every state has its own rules, but we're just talking at the federal level. Germany, on the other hand, is very different because even if you are a US citizen, so you're not a German citizen, and you're living in Germany, and your US parents pass, and they want to pass their estate to you, then you're liable or potentially liable for German inheritance tax. It's all about your ties to Germany. So you are a German resident, or the asset is in Germany. So it's a completely different concept. And the tax rates with German inheritance and gift tax, they vary significantly. So anywhere between 7% and 50%. And it's very dependent on your relationship and the amount that you inherit. So if this is, your spouse or your parent, you have a much higher exemption than if it's just a family friend who wants to leave you some money. So it's just something to be aware. Also, there is a disclosure requirement in Germany. You do need to report any foreign inheritance within 3 months of receiving that. Again, it's very different with US estate tax, where again, the estate is handling the tax filing and you have 9 months.
There is a disclosure requirement with US if you're getting inheritance from a non-US person. So this isn't a taxable thing, but it is an important filing requirement. So if you inherit over $100,000 from a non-US person, this has to be reported, timely filed with the tax return for the year that you inherited this. Yes.
Does it matter? Whatever it is.
Does it matter if you're married to the person who was getting the inheritance? If the inheritance is to a non-US spouse,
Yeah.
then that would.
Yeah, I would
I
say
would say
no.
no.
So if let's say your husband we're just talking about the US side here, I'll just say that. So you're married to a non-US person, your non-US person inherits directly to them 200,000, then no, there wouldn't be a US disclosure requirement.
Right.
Because if your husband's parents left you 200,000, then yes, we'd be over the $100,000 threshold.
Yeah.
Unless the only issue I would see is if you decided to file married filing jointly with your husband, then you basically have dragged him into the US system, which I would never, ever recommend. And then there actually could be a filing requirement because now this person's in the US tax system.
Mhm.
Does it matter? Let's say it's not money, it's like they, I don't know, house.
A house.
like, a bunch of properties. Does that?
Yeah, it's inheritance of fair market value of whatever assets. So whether it's cash or investment accounts or a house or.
But if it
Um,
goes to them, then is it fine, like the system, or is it just matter if it's, sorry.
Yeah, the question is whether it can go to a non-US spouse. I would say in most cases that would be outside of the US system. I think you could, depending on what country you're in, you could have some common property laws. So if the laws of the country say this gift is actually jointly to the spouses, then I think in some cases the US may take a similar.
Yeah, but
um,
under like most marital law, that gifts and inheritance are outside of that. So you just, again, everything we're saying is a big asterisk next to it. But I would say generally it wouldn't be included, but I would say, again, orange flag, be sure to ask questions, especially if you're filing jointly, then I think there's a potential exposure there.
Yeah, definitely. If you're getting a gift of a house that is to joint spouses and you're included in that, then that
Yeah,
would be
just to
filing.
ask
Yeah.
more questions. Yeah, good question. We can go to the next slide. Just for completeness, I included a whole slide on the different German gift and inheritance tax brackets for 2024, just so that you have that information as a resource when you want to look at that. Because I love doing fun things like that. So we can go to the next slide. And actually, this is perfect. We're right on schedule. We can dig right into all the questions. Do you want to change the?
Yeah.
No, we'll keep this slide up and then we'll do the questions on our side.
We can see them.
And do we have any questions in the chat while we pull this up? Okay, great.
Have to get the questions to appear. Sorry.
Oh, you're fine. We go to results, I think.
Technology. Do you want to start off with one question and I'll do some?
I'm trying to remember. I mean, I
Sure.
remember looking at all of them, but I feel like just. Oh, here is this it? Oh, here they are.
Okay. Our German bank recommended placing investments in my spouse's name because he's not a US person. Is this a good idea?
Yeah, I mean, that's an interesting idea. I'm very open to that, and we actually we do planning in that way where we have a non-US spouse and that person is fully outside of the US tax system, and we're not planning on moving back to the US in the next like couple of years, then absolutely there is likely investments that make sense for your non-US spouse person to look at that make zero sense for you. The thing that I will caveat there, though, is I work with a lot of couples who are going through divorce or preparing for divorce. And divorce is a very common occurrence, especially in the expat community. And so do I think it's wise to put all of your assets in your husband's name to avoid paying taxes or wife's name to avoid paying taxes or having filing requirements or anything like that? Absolutely not. And I've seen so many cases where I've had one spouse who's a non-US person have a total fear and not understand how the US tax system works and just make the decision for the family. No assets are going in your name and it'll be fine. I'll control everything. And then we go to the divorce. And even when we look at prenups and postnups and marital law, it's very messy. And you can have a spouse basically control funds until there's a court order. It gets very, very messy very, very quickly. And so I would just say it's a good planning technique, but both spouses should also have assets in their own name. And generally when we're working with couples who are, one is a US person and one is not, we might have like a joint account that the daily living expenses are coming out. It's not an investment account. It's just, a joint checking account essentially. And then everyone has their own money and their kind of own pot of money. And maybe we're doing planning from a family perspective. Hey, yeah, we should maybe do some additional German pensions here for the non-US person, the non-US person. Again, it's a really good idea to be asking questions and understand if this all goes terrible, how do I get that money back?
Yeah, from a tax filing perspective, it's easy. But yeah, a little more complicated. Right. The next,
There's
yeah.
a follow-up in the chat. When, in that case, when you put assets in the US partner, assuming a stable marriage, what happens when the German partner dies?
So
Does this create problems with inheriting the German partner's assets?
So then we have to look at German marital law and, what were the level of assets, and is this assets that were acquired during the marriage, and that kind of gifted in between each other, or is this an actual true gift? Then we have to look at what the thresholds are. Yeah, I mean, again, it gets kind of complicated, but generally it would be looking at, is this a gift or is this just whose assets are what?
Okay, the next question is, with German retirement and life insurance products, will I be taxed on this money once I access it after retirement?
It's really a two-part question, because I think the first question is, will I be taxed in Germany at retirement? And so then we have to look at, because I mean, a lot of like German retirement plans or life insurance products, they come with a tax incentive. There's a reason why people want to buy these products. And so there might be a tax incentive on the German side. Germany, as everyone knows, is going to want their tax at some point. And so then, when you go to take the money out, there might be some tax on the German side. So that's like the German side. And then on the US side, again, we have to go through the process of saying, can we fit this in the box of qualified for US tax purposes, or is it outside of the box? It's not qualified. It's not qualified. We're not really getting tax incentives. And so we kind of fully own the basis of that retirement account or that investment product in a different way than how Germany is seeing that. And so when you go to retire, Germany might say, okay, now we're going to tax this. And then all of a sudden you have like some more, foreign tax credits on the US side. But then from the US perspective, there may not be additional tax due. Yeah.
There's just a billion different types.
Yeah. And then I'm like,
products,
my
so-
brain could go down like 27.
So the question is, what is it actually?
Yeah.
What would this be characterized as in the US? So if it's something that's a PFIC, so this is a retirement product where inside the retirement product, you're investing in a fund. And then this can be characterized as a PFIC. So now are we doing punitive taxation on a PFIC? Yeah, it's quite complicated. I think some are classified a little more as an annuity product. So yeah, probably yes to tax, I would say. The question is how much and where to which country.
Yeah, and in general, and again, I don't like using rules of thumb when it comes to cross-border, but if it's a lot of our clients who have German pension plans through their employers, and there's like a requirement, those are generally okay. But I've also had private pension companies come into the employer's workplace and sell that private pension like on the floor, and maybe the employer is giving some incentive for that private pension, and those aren't generally not good. And so it's really like looking at every plan document. I love your response. We have to, what is it? What is it is the first step.
Yeah, probably the more complicated it is, the more complicated it is. Yeah.
Can I ask like a middle follow-up question to
Yeah.
that? So state pension, like that you always get usually okay, you said.
That's okay. State pension is fine.
Also,
Pension for me, questionable, right? That I searched out myself, I'm investing in this. What about the like company pension where like the company pays for like the company extra pension? Is that something? What's the opinion on that? I guess.
In most of the cases I've seen, it's okay. Sorry.
Was that not loud enough? That was really loud.
Maybe I should pass this around. Sorry, the question was, we have the government pension as like the first, it's like a 3-pillar system. Government pension, and then we have the company pension, and then we have the private pension. Government pension is always okay. There is a treaty. It's you get that. That's a great benefit for you. Then the second pillar is the company pension, and in most cases that I've seen, that's also okay. And then the third one is the private pension, and that comes in a lot of different flavors. And in most flavors I've seen, it's not okay. But I'm sure you have lots to add to that.
Yeah, I mean, there's a billion different types of private pension plans, and they're all structured differently. And even when they look on the face that they're similar, I'm usually looking at the terms, and there can be quite a wide range of terms. The I would say if you're investing into a fund through a pension product, that is a red flag.
Mhm.
Red flag.
Yeah, because I was thinking about a client situation we had last year where it was a startup and I think it was like Allianz, actually came in as like a benefit and they sat down with all the employees. And my employee was like, she called me and she's like, hey, can I do this? And I said, I really don't think so. And she's like, no, the Allianz guy is saying it's fine, it's fine. And I'm always like, so a German insurance broker is telling you it's fine. Oh, okay. Can you get a written opinion on that from a US accountant? And then they came back a year later and they said, oh, actually, you are a US person. She was always a US person. We can't actually sell that to you. And now we have to get you out of this product. And it is like just kind of created some like, issues. So that's where I always say like there's the company pension and then there's like the people that come into the company. That's really a private pension. And that's what you want to be aware of.
Yeah, that one. Okay. I think we kind of.
Yeah, we talked about this a little bit. If anyone has any follow-up questions to this, the question is, I'd like to buy a house in Germany. Is there anything I should consider from a US tax perspective? We talked about this a little bit, but I'd like to expand because I hear a lot of questions about buying rental property or buying like investment properties. That seems really common. Or maybe I want to buy a property, live in it for a couple of years, and then, oh man, now I'm married with 3 kids in this tiny little apartment and it doesn't work for us anymore. So now we want to rent that out. So we talked a little bit about, especially for personal use, especially if you're holding that property for a long time, and we have a huge differential between like the US and the Euro, the USD and the Euro. But I want to talk a little bit about the rental property and the differences there. I thought you could expand, but I can also expand.
Well, so if it's for personal use, then you have the private personal residence, primary residence exclusion.
Which is on the US side.
On the US side.
Yeah.
So you can exclude $250,000 of a gain, and that's per spouse. So if there's 2 of you who are US people, then you can exclude up to 500,000 of the gain. So this is pretty nice. If it's a rental property and you haven't lived in it for 2 of the last 5 years, then you don't get this. So that is what can lead to this really high tax.
And the accounting on it is different. We have German accounting for this rental property, and then we have US accounting. And those, again, they don't really quite match up, kind of closely, but not really. And so one of the issues that I see occasionally is the required depreciation. And so you can't choose depreciation in the US tax system. You have required depreciation. And when it's a foreign property, I believe it's 40 years. And so when you go to sell that property, now we have to recapture, or what the US system calls recapture the depreciation, which means that's taxed at a higher tax rate than capital gains. Again, it all really comes down to how much tax did you pay on the German side, how much tax did you pay on or how much tax is due on the US side. You'll always just pay the higher of the differential.
Yep. So if you have a rental property in Germany and you're getting a profit on that, and a lot of times with rental properties, once you factor in the depreciation, you're not necessarily getting a tax gain. So from year to year, you can often have a loss. So in the US, you can stack up these losses and then offset the gain at the end. So that's a little way to kind of ease the tax burden. Yeah. And then in Germany, if you are paying a gain, then you're going to pay, or if you have a taxable gain, then you'll pay taxes on it in Germany. And then you get credits for those taxes to offset your US taxes owed. So you calculate your taxes owed in the US, and then you can offset that with whatever you paid in Germany.
And we didn't dive too deeply into the foreign earned income exclusion versus the foreign tax credit. But for, I don't know, kind of generally, once you're earning over 100,000 euros in Germany, I'm really thinking, we should be looking at the foreign tax credit, because the benefit of the foreign tax credit is you get a buildup of foreign taxes that can carry forward for 10 years. And so it can become a powerful planning tool when we have this kind of excess foreign tax credit Versus if you're just taking the foreign earned income exclusion, yeah, you can exclude $126,000 plus some, maybe if you're renting, some additional housing expenses, but it's a use it or lose it. And I really like the flexibility of it kind of building up those dollars, and they're your dollars. And if all of a sudden you decide to go move to Dubai or Switzerland or somewhere that's a lower tax regime, you get to take your foreign tax dollars, and then that becomes a really exciting planning opportunity.
For everyone who wants to move to Dubai after 10 years in Germany.
Just throwing it out there. I'm just thinking of the low tax jurisdictions.
Yeah, I think the
Or
other
no
thing that
tax.
maybe comes up with buying a house is a mortgage interest deduction comes up sometimes. So in the US, normally this would be an itemized deduction. So you can either take the standard deduction or you can take the itemized deduction. This is if it's a personal property. What I often see is that there's not a lot of value in taking the itemized deduction because it has a funny effect on the foreign tax credits where it reduces the foreign tax credit. So sometimes like the foreign tax credit is a very goofy, it has weird dynamics. It is a strange calculation. And so sometimes you can fiddle over here and you create a bigger hole over here. And so a lot of times, yeah, I'm trying to think if I've ever seen an itemized deduction that worked well, maybe in like a mid-year move situation. But a lot of those tax planning things do help on the German side. So you're paying a lot of taxes in Germany, and you can talk to a German tax preparer about getting those deductions on the German side rather than on the US side.
Yeah, and on the German side, I mean, most cases we generally have enough foreign tax credit. In Germany, again, high tax jurisdiction, we generally have enough to cover our US tax liability. I'd say net investment income tax is still something to just be aware of. If you were earning over $250,000, if you have investment income, there may be an additional 3.8% tax. And again, there's been some movement in the courts, but in Germany, it's still, you can't use the foreign tax credit to offset that additional 3.8%. So we can just manage that by looking at tax advantage accounts versus, or tax qualified versus tax deferred versus taxable accounts. Wait.
I've done it wrong.
No.
Were there any other questions about?
We had like 40 questions, so I don't.
They're there. I'll pull them
Okay.
up. On housing.
Oh, is there, can you?
Question is, the person's been living in Germany for 20+ years, but have elderly parents in the US and expect that they need to return to the US for a period of time, most probably 2 years, but not indefinitely. Long-term plan is to come back to Germany. Question 1, if they reestablish US residency or the mom or stepfather passes away, does Germany have any right to tax that inheritance? Question 2, what would be required to establish US residency and how?
Oh, wait, we should stop because I cannot remember all those words to repeat them.
The first one is the reestablished residency and that one of the parents passes away.
Okay, so yeah, so we're setting the scene. We have I'm guessing, US citizen who has aging parents in the US side. The US parents have, we'll just assume, significant assets that they want to pass on to their child. A child in Germany decides to relocate back to the US and support their parents. I would assume they've broken their ties with Germany. Maybe they're holding German citizenship, but otherwise they've broken their tax residency. And in Europe and, well, most of the world except for the US, it's a residence-based tax system, not a citizenship-based taxation. And so this is where we're having all these crazy discussions that no one else is having in any other country, because we are all US citizens and we're just kind of tied to the system regardless of where we are in the world and building our lives. So this person breaks their tax residency in Germany and now inherits a bunch of money and property in the US. Is there potential German inheritance tax exposure? I mean, on the face of it, I say no, but there could be a lot of other issues. Does this person own a company in Germany, and are they going to be subject to like an exit tax when they try to leave Germany? I mean, there's a lot more planning considerations here than it's not black and white.
Yeah, with residency also, So the tax language is around residency as center of vital interest. So this is a really gray area. If you've ever filled out your own tax return and done the 2555, there's a lot of questions on there about what type of housing do you have? Where is your
This is residency
family?
versus domicile. Where is the center of your life?
Mhm.
If this person has a husband and children and they say, you're staying in Berlin and you're continuing your life, well, I go take care of my aging parents. I think there would be an argument that you're a center of where's your heart? Your heart is in Germany,
Mhm.
not in the US.
Right. So this would be a question to really look in detail with a German expert who knows the case law around this specific scenario and what the German courts are likely to go after, because you really want to clear if it's in the court's interest. I know some funny cases from the UK where around inheritance tax where they're like, actually, no, you moved away, but actually your heart was still here. And so, yeah, it's a tricky one.
I think you actually answered it. The second question was, what would be required to establish US residency and how much should I be traveling back and forth all while having my base in the US?
Yeah, so what would be required to establish US residency in that clear case, I think would be to discuss with a German state expert
Yeah.
to really know that if there's a significant amount of potential taxes on the line, that the finance has a significant interest in, to really err on the side of caution and to understand exactly how that's been litigated in the past.
Mm-hmm. Yeah, that's a great point.
Did you have a
I kind of had like a follow-up question again.
Yeah.
Does dual citizenship have any factor into this, or is this also like go talk to your German?
Does dual citizenship factor into it?
I would
It's hard to say. I would
say an immediate no, but again, I'm putting an orange flag on this. This stuff is so case specific. I mean, that's why I love this, right? Everyone's case in here is a different puzzle. And I don't we have to know what the pieces are, and then we can figure out what the answer is.
Yeah.
But just having a second citizenship or being a German citizen, I mean, you could be a German citizen living your life in the US and not really have any ties to Germany, and
yeah,
you're not gonna have.
if it's a home is where the heart is situation, there's a range of that related to a passport. Yeah. And it just depends on, that's a court.
It would not
That's the
be,
court.
because I've gotten this question a few times, it would not be a reason to not be applying for German citizenship for me or for anyone that I like, right? You're already all German residents, I'm assuming. And so your life is already here. And so now if you want to change your residence, we just have to prove like, where are your social clubs and where is your driver's license and where are you voting, and really understand where your heart.
Your financial ties,
Mm-hmm.
social. At a tax conference, they suggested that where your pets live is probably where you live. Yeah. Yeah. So there's a lot of factors that can go into this. And yeah, depending on what's on the line, there are cases where various courts are pretty interested in going deep into someone's life.
And if you are sitting here and you're saying, well, I am a German resident and no, I'm not just going to move back to the US to save some taxes, then, and we're looking at, a potential inheritance from family in the US, that's, maybe a couple million. It's worth engaging a international like German estate attorney who specializes in US and German law, because there are so many planning opportunities. I mean, it's ridiculous. You can plan anything as long as the person's still alive and you haven't actually received that inheritance. There's a lot of ways to delay and kind of protect that US inheritance, but you need to do the planning. And that is a tricky thing, because whoever wants to leave you those assets, they kind of have to lead the planning. And so that means you're having to have maybe some uncomfortable conversations of, okay, well, if we don't do the planning, how do you feel about me paying 30% German inheritance tax on the money that you want to leave me? And I've had some clients go to their parents and say, I don't care. when I'm done, I don't want to go through the planning. I've done my, California law or California will and, done all the planning from the state and federal level. I don't also want to have to now deal with a German lawyer just so you can save 30%. You want to live in Germany, you live in Germany. And other families who are like really into it, especially when you have illiquid assets, like you have large real estate holdings. I mean, this is something you can't just like, it's going to be fine. No, I mean, probably not. Yeah, we can keep going.
Okay, so this was the same,
Yeah.
similar, they were lined up.
Okay, cool.
Okay.
Can you share advice on how to invest as a US citizen in Germany with no US bank account? I mean, I would say everyone should have a US bank account, right? You may think about COVID when there was all this COVID stimulus. People who didn't have a bank account had a really hard time when that IRS check arrived and they wanted to go and deposit it. It's almost impossible. The State Department Federal Credit Union is the only bank that I'm aware of that if you have no ties to the US and you need to open a US bank account, you can open one with a foreign address and they will take you. So I would say at minimum, if you don't have a US bank account, go open one there. Especially, I mean, I don't know, my grandma still wants to send me checks for my birthday. So I'm not going to tell her to not send that money. So, that's good. Also, I don't know if they have a mobile banking app, but that's worked out really well for us as we've had to like.
Yeah, E-Trade told me that I haven't tried it, but E-Trade told me that they have bank accounts for people abroad without US addresses.
Yep, Schwab also will allow you to open an account with them. You can have checks. I actually will use the checks. If I have to send like a wedding card, I will put a check in there because what else you do. And so you can get checks through Schwab. Those are free if you have an account with them.
This is really convenient if you ever need to pay a small amount of US taxes or get a refund. If you have child tax credits that you're getting refunded, that's much nicer to pay. Sometimes if you have some investment income, there can be a little overhang between the foreign tax credits. So sometimes I see tax calculations where people owe $16, $24, and this is a little bit annoying. So if you just have a way to do it by direct deposit, direct debit, it's slightly less annoying.
As a US person, you're tied to the US tax system, and therefore you cannot just ignore the US financial system. You kind of have to continue to figure it out, even though it's not as fun when you're outside the US and not as easy.
Yeah. Are there ways to invest if you don't have what's outside of the US?
Yeah, so again, Charles Schwab will let you open an account. Interactive brokers will also let you open an account. I mean, again, you go back to the MiFID rules though, where your hands are suddenly tied because you can open an account, you can't buy US ETFs. So then you have to actually go through an investment advisor to be able to buy those ETFs. That costs money, that's expensive. And so it creates a barrier to entry where if you're in the US, you can have, $2,000, $500, go open a robo account, and it's much more accessible because once you are talking about international, again, it doesn't really matter how much money you have, it's complicated. And so you have a much higher level of compliance. So yes, you can do it, but again, it's more complex.
All right. All of my German self-employed income would be excluded through the foreign earned income exclusion. Is there a reason to take the housing deduction or other deductions? So you can take the foreign earned income exclusion, that is per 24. Did you say it's 126,500? Yeah, so that's quite nice. So as long as your income is below that, you report your income to the IRS and you say, well, it was below this. Add the form 2555 to your return, answer all of the questions about your life, and then you can exclude it. There's an additional housing deduction. I honestly can't think of a return that I've done where it made sense to take the housing deduction because either it's already zeroed out with the foreign earned income exclusion or we're just moving to foreign tax credits.
Which is another little flag. If you're looking at your return and you're like, okay, I excluded all my income, so 126,000 plus, and then I also am excluding this additional, you should be asking the question, does it make sense for me to switch to the foreign tax credit? Like that's a big, because that could really be a good
Yeah,
tool.
the housing deduction is a little bit complicated. I think it makes sense in a low tax country.
Mhm.
So if you're living, somewhere, Dubai, and you haven't spent 10 years in Germany building up your foreign tax credits, then you can get a little extra oomph out of the exclusions. Other deductions, so like we see this sometimes if someone's contributed to an IRA, but really you just get to zero. And once you get to zero, you're at zero. So
To the refundable child tax credit, which you can only take if you don't use the foreign earned income exclusion. So yeah, I mean, if you're making like 40,000, you're self-preparing your tax return, I would probably take the foreign earned income exclusion and be done with it and move on with my life.
yeah.
If
And
you-
even if you're self-employed, like every single deduction, once you get to zero, you get to zero. And so if you're doing it yourself and you don't want to go through every single transaction, every single bank account, statement, however you're doing your bookkeeping, depreciation on your computer that you bought, I think you're usually getting to zero anyway. Yeah.
I'll read it. You can give it a first
Okay.
go. What is your opinion about businesses like MyExpat Taxes? Would you have any security concerns about tax data being kept on their servers?
So I can't speak to that specifically, but data security is obviously a huge concern with your tax preparation. So, we have social security numbers, dates of birth, address, and bank account numbers. This is like the perfect storm. It's very attractive information. So it is really important when you're using any service provider to feel confident that they have security in place to keep your data protected. I know what we do. I think it's a huge concern for me because a data breach is, I live and die by data security. So we're keeping our data quite secure on secure servers. I have it locked down. My team can't take it in or out of a system. We're using specific tax portal. So we're not using like Microsoft's OneDrive, whatever, provided by tax service provider that is compliant with. So the IRS has data security requirements, and every single state also has data security requirements and also GDPR requirements. So yeah.
I think it's always important to be asking these questions and just to understand the system. Now, I have clients who do ask me about our security protocols, and we will, disclose that we have to go through like an audit for our compliance every year with our security, our data security. But I also have clients who will send me their tax return that's not even password protected through email, or this is my account number, or so
Here's my social security number. And
yeah.
I'm like, oh my God,
did you need
don't.
that? Yeah. Yeah. And then it's like, I can have the best security in the world, but if you start communicating outside of the systems that we've created to keep your data secure, then that's really hard to do.
Yeah. Dropbox is
Yes. So
scary.
it's also, I would say, your job as a client to ensure that, yes, it's annoying to log in and then like upload the file. I get it. But if you send it over email unsecured, it doesn't matter what security I have.
Yeah. And a lot of the most secure systems are unfortunately not the most like intuitively built or don't have the highest, they're not super user friendly, but this is the price we pay for having. I know the portal I used a couple of years ago, they had a breach and they shut down, like they locked it all down completely until they completely figured out. And this is like one of the main US tax providers. And so, having providers who know the value of the data that they're holding and are acting accordingly is important.
Yeah, so we will wrap up the Zoom portion. Thank everybody online for joining. Thank you, everybody in the room. Thank you, everybody who is going to receive this recording, who couldn't be either live or on the Zoom call. So yeah, so we'll have the recording available in a few days. We'll get it on a YouTube link, and then I'll send out an email to everybody. My email is events@democratsabroad.de. I think it was in the RSVP email, but I'll make sure that that's in the email that you get as well. And so if you have questions, please feel free to reach out to me. And thank you so much to Arielle and Emily. And we'll wrap it up. Thank
Yeah,
you.
great. Thank you so much for having us.